This video is all about LEAPS options. What are they? How can you use them properly? How can you use them in a way that won't blow up your account in a bad way? My name is Randy Perez. I'm a 20+ year stock and option trader. I'm excited to share one of my favorite options trading strategies with you, and that is how to use LEAPS options to profit in your account. And like I always do on this channel, I'm going to show you a real life position I'm in right now. It'll help you see how I use LEAPS options to get potentially great gains while decreasing the amount of risk that I have in the trade. But first, what are LEAPS options? Well, it's actually pretty simple. It's just an option that expires over a year from now. So for example, this option here on January 16th of next year, it expires in 345 days. Well, that's not a LEAPS option. If you go to the March expiration, this option expires in 408 days. Well, because it expires in over a year from now, that's a LEAPS option. That's it. There's nothing else special about LEAPS options. They just have a longer expiration than nearer date options. Now, what might sound confusing is what LEAPS stands for. Now, it's not important that you remember this, but just so you know what LEAPS stands for, as you see here on the screen, it stands for Long-Term Equity Anticipation Security. So let's just call it LEAPS. That's a lot easier to remember. So what type of companies can you trade LEAPS options in? Well, it's really any company that has longer term options. They can be highly volatile stocks, or they can be very stable stocks. As long as your options have expiration dates that are over a year from now, you're trading in a LEAPS option if you choose that expiration day. But what are the advantages of trading LEAPS options over shorter time frame options? Well, here you see some points I thought you should be familiar with. The first and biggest one is time. You have more time for the trade to go your way. During the life of any trade, there'll be times where the trade probably goes your way and times where it doesn't. Well, if you have a longer term option that you bought or you sold, well, it gives you more time for that trade to go your way, then you can close it out early for a win. The next possible advantage is that it can provide you some more stability. Well, how does that work? Well, because it's a longer time frame option, it tends to act more like a stock than the shorter, maybe even zero DTE options do. Now granted, there are some zero DTE options that act kind of like a stock. With a longer term option like a LEAPS, it can give you more stability, and over the long term, it can act more like a stock does. Just know that it won't always act like a stock. It depends on which strike price of option you pick, and we'll get into that in just a little bit. A third thing that some traders like is that LEAPS can give you leverage. You can control the same number of shares with a lot less money using LEAPS than it costs you if you bought the stock outright. And this can be a good or a bad thing, as we'll get to in just a minute. And finally, they can give you some greater returns. Just keep in mind that with greater returns, there's usually greater risk, and those greater returns can also turn into greater losses if they're not structured properly. So percentage-wise, you can potentially see higher returns using LEAPS than you would with shorter term options or even with buying the stock outright. Now let's talk about a couple important things that make up the value of a LEAPS option. Because whether you're buying or selling a LEAPS option, you want to understand kind of just some fundamental things or how they work. I'm going to use the example of an NVDA trade. And that's the trade I'm going to share with you that I did just a few days ago. But let's talk through some of the basics of what makes up the value of a LEAPS option. So we're going to focus on the call section here of NVIDIA. So here we're looking at the option chain that expires in 408 days. This is indeed a LEAPS option for NVIDIA. We're going to look at the $100 call option. A couple things I want you to pay attention to here. First, notice that the stock is trading at $120 per share. Since we're buying a call option that's at the $100 strike price, that option is worth at least $20.46 per share, because that's the intrinsic value of this option. Everything else is known as extrinsic value. As you see here, this option closed last night around $36.50 per share. If we do some quick math, as you see here, that option is trading for around $36.50. There's $20.44 in the money. Well, the extrinsic value, or the time decay portion of that option, of that LEAPS option, was about $16.06. Just know that that $16.06, if we now fast forward 408 days to expiration, that will be gone. And the option will only be worth how much is in the money. In this case, about $20.44. How much will this LEAPS option lose per day due to that time decay? That $16 that would just go bye-bye in about a year? Well, that's represented right here under Theta. It's 0.031. So this LEAPS option will lose about 3 cents per share per day. Since each call option represents the control of 100 shares of stock, this position would lose about $3.10 per day for each call option contract at that $100 strike price if it expires on March 20th of next year. Just understand that with LEAPS options, just like any option, the extrinsic value will be gone. It'll be zero at expiration. The other important Greek I like to look at when it comes to LEAPS options is delta. And this is represented in this column right here. And that's the estimation of how much the value of this option will go up or go down based on the next dollar that NVIDIA stock goes up or down. So if NVIDIA stock were to go up by $1 today, I'd expect the value of this $100 strike price call option to go up by 0.756 per share. If we do the math, since the LEAPS call option controls 100 shares of stock, the value of one contract of this $100 strike price call option should go up by about $75.60 for the next dollar that NVIDIA goes up. Now, that's not set in stone, but it's an approximation. There are other factors that go into the value of an option, but those are the two main ones I like to consider when I'm trading in LEAPS options. Keep in mind those numbers there, 0.756 for delta and 0.031 for theta. Now let's look at some options that expire in a nearer time frame. So here's one that expires in just 16 days. It's the same strike price of $100. Notice its delta is a lot higher. Its delta is 0.92. That means that this $100 strike price call option, it'll go up and down in value about 92 cents for the next dollar that NVIDIA goes up and down in value. So if you really want an option that acts a lot more like a stock, well, a deep in the money call option might be something you would consider. But let's look at theta next. Remember, that's time decay. That's the extrinsic value. That'll be all gone. It'll be poof, gone at expiration. Notice that this $100 strike price call option that expires in about 16 days, it'll lose about 8 cents per share per day. So that theta or time decay, it's a lot higher in this nearer term option than the LEAPS call option we're looking at. One thing I like about LEAPS options, it lets you control stock for a lot less money than if you bought the stock outright. Here you see we're controlling that same NVIDIA stock. And if we bought that $100 call option that expires in 408 days from now, it would only cost us about $36.50 per share. Or for each call option contract, which represents controlling 100 shares, it costs us about $3,650. How much would that save us compared to buying 100 shares of stock? Well, if we bought 100 shares of stock, it costs us about $12,050. So we're saving $8,400 and we're controlling those same number of shares, that same 100 shares of NVIDIA stock. I like that. It means that if NVIDIA were to crash and go to zero, we'll only have $3,650 at risk as compared to the $12,000 we have at risk if we bought the stock outright. So it gives you kind of some protection if you use it properly. And really for me, if it's a non-dividend paying stock and I plan to own at least 100 shares of the stock, or I want to control at least 100 shares of the stock, I generally would just go with the LEAPS option. And one of the main reasons is that built-in protection. I really like that built-in protection. In fact, to me, there's no real benefit in owning the stock outright if it's a non-dividend paying stock. And the one exception might be if you want to sell some call options against that or do a cover call on the stock. But really, you could just do a poor man's cover call, which is the exact position I'm in right now in NVIDIA. But some people say, I don't want to deal with checking the position daily or every couple of days, which is what you need to do if you do a poor man's cover call. With a cover call, you technically could put it on and just leave it alone. And if the call is assigned early, well, they just call your shares away. But with a poor man's cover call, since you don't own the shares, you own a long-term option, well, you have to keep track of it. You want to make sure that the near-term call option you sold still has some extrinsic value. That way it won't be assigned early. Now let's talk about some things you want to keep in mind when you're trading LEAPS options. Remember, you can buy and sell calls and you can buy and sell puts that are LEAPS options. So when should you buy a call option? Well, obviously you want to buy it when you think the stock is going to go up in price. And when should you sell a put option? Well, you just sell again when you think the stock is going to go up in price, or at least stay where it's at, or stay above the strike price of the put option you're planning on selling. And of course, you could do the opposite. If you think a stock is going to go down in price, you could buy a LEAPS put option. So you really can trade them the same way that you trade regular options. Now, if you're going to buy a call option, you want to make sure that you have a long-term bullish outlook. You want to make sure that you think the stock will go up in price, so the value of your LEAPS option will also go up, because remember, you got that little theta decay in there. So the stock has to go up in price faster than what that theta decay or time decay is eating away at the value of your option. In this case, remember those $16 of extrinsic value? So this option will lose $16 if NVIDIA was still at 120 at expiration. So you would need the NVIDIA to be up above 100 plus the $36.50 this option is selling for at expiration. So it needs to go up about $16 per share between now and March 20th for you to make money on just this LEAPS call option. And one way to do that is just to use technical analysis. Here you see a chart of NVIDIA. Now, it's been kind of choppy here recently with some AI news, but overall, up until that point, NVIDIA was looking pretty interesting. It was a nice bullish looking chart over the long term. So you want to make sure that the stock you're trading in, if you're going to buy a LEAPS call option, do you expect it to keep going up in price like NVIDIA was doing up until about a week and a half ago? I'm not saying a LEAPS call option won't work now for NVIDIA. That's actually the position I took with a twist, like I'm going to show you in just a minute. But you'd like the chart to be bullish if you're going to buy a LEAPS call option in a stock. We can't talk about responsible trading unless we talk about managing risk, which I know risk management is like a boring topic, but let's rephrase that. Let's call it, instead of risk management, let's call it preserving your capital, or making sure you can keep playing this game with us. So what do I mean by that? Let's say you had $12,000 set aside that you wanted to buy some position in NVIDIA with. You're bullish on it, you thought it might go up in price. Well, you could buy 100 shares, and that'd cost you about $12,000. But instead, you're like, you know what? I like the idea of these LEAPS call options. So I'm gonna buy me some LEAPS call options. And here's where traders can get into trouble. They take that same $12,000, they say, well, I can just control more shares. So you take $12,000 divided by $36.50, this LEAPS call option will cost them, they'll say, you know, I'll buy 300 shares worth of options in NVIDIA. But here's the problem with that. Remember you're not buying a stock. So truly, if you bought 100 shares of NVIDIA and it cost you $12,000, NVIDIA could go down to 100, and that investment will still be worth about $10,000. That's not the case with the LEAPS option. Remember, you're buying the $100 strike price call option. At expiration, this $100 strike price call option will only have any kind of value if it's trading above $100. So if you spent $12,000 and bought 300 shares worth of LEAPS call options in NVIDIA, and NVIDIA was at or below $100 per share at expiration, well, that whole $12,000, it's poof, it's gone. So be careful, because of LEAPS options, if the value of the stock is not above the strike price of the call option you bought at expiration, well, all that money is gone. But on the other side of that, what I do like about LEAPS options is that if NVIDIA were to go up in price, the value of this option could go up in price percentage-wise a lot higher than the value of if you bought the shares for cash. So say, for example, NVIDIA went up $36. So whereas the value of your LEAPS call option would have almost doubled if it went up overnight, well, the value of your shares would only have gone up about 30% for that same $36 move. You might have similar dollar amount at risk with a LEAPS call option and own the shares, but percentage-wise, the loss could be a lot greater with LEAPS options as compared to owning the shares. And the flip side of that is also correct if the stock goes your way. One more tip I want to share with you before I move on to the real details of the poor man's cover call, which includes a LEAPS call option that I'm in right now in NVIDIA, is that anytime you trade options, you want to most likely use limit orders. And the reason is that the difference between the bid and the ask, it can be wider than with the stock. You know, with the stock, you pretty much could trade market orders for the most part. With options, I tend to like to trade limit orders. You just want to make sure that the fill price you're expecting to get is what you actually get. Now let's move on to my real trade I'm in right now with NVIDIA that I actually share on YouTube and with my patrons. And by the way, I share all my trades with my patrons, but I decided to share this one with everybody, those on YouTube and even my free patrons. So here's the trade I'm in right now with NVIDIA. I took this trade a couple of days ago. I actually took this trade based on a poll on my community tab or my post tab here on YouTube. So thank you to everyone who voted on that poll. This is the trade you wanted to see me do. So here's the trade I did. First of all, step one is I bought a long-term call option. Now it wasn't quite a LEAPS option because it expired in a little bit less than a year, but it was a longer term option. I bought the option that expires in 347 days. And I bought that same 100 strike price call option. Now for that, as you see down here, it cost me right at $3,461, or about $34.61 per share. But I didn't just want to buy that call option, because remember that theta or time decay or extrinsic value, it eats away at the value of that option. So I wanted to help myself out with that. So I sold a call option against it, or in other words, I turned it into a poor man's cover call. And here's how I did that. Now I'm going to show you the marriage of these two positions in just a minute, but here's the short call option I sold. I sold the call option that expired in about 20 days from when I sold it. So I sold the February 21st, 117 call option. Notice what happened to the value of that call option I sold that expired in about 21 days from when I did it. Well, if NVIDIA were to go up in price, as you see down here on the bottom, this is the price of NVIDIA. Here you see the return. So if NVIDIA were to go up in price, notice that I'll begin to lose money on this position. If it ended up right where I sold the strike price, right at 117, I'd have max gain. I get to keep all the money I received for this call option that I sold. But if it were to go way up in price, I can actually begin to lose money on this short near-term call option. That's one reason why I bought that longer-term call option, because here you see the profit and loss graph of that longer-term call option. You might also call this the risk chart. As you see here, even though that short call option will go down in value, because as you saw in that previous chart, if NVIDIA were to go up in value, well, that short call option, I'd actually be losing money on it. But since I own this longer-term call option at a strike price below the call I sold, well, the value of this option will actually go up if NVIDIA goes up. So if you were just bullish on NVIDIA, you don't want to do anything else, you could just buy this call option. But if you're like me, you like to get some extra cash flow. Now let's put those two positions together. So we have the long-term, almost LEAPS call option that I bought that expires in just under a year. We have the shorter call option that I sold that expires in less than 21 days. Here's what the profit and loss graph looks like for that, or the risk profile. Notice that ideally, I'd love for NVIDIA to end up right at 117 with the strike price of the call option that I sold that expires here in a little less than 3 weeks. If it did that, then the profit and loss graph would look like this. So I received max profit. I'd be at a profit of about $550 in about 3 weeks for doing that position. However, I do plan to keep this position going, so I wouldn't close it out. I'd adjust it at that point. But just note that if NVIDIA continues to go up in price, the value of that short-term call option will go up faster. In fact, if NVIDIA were to go way up in price over the next 3 weeks, say up to about 145, I'd be at a break even for this overall position, even though the stock went the way I thought it was going to go. There's a lot of things I can do to adjust this position. I am checking it once a day, which just takes a few minutes. But if you were just to leave it alone and not do anything, this dark blue line is what the profit and loss would look like of this entire poor man's covered call. By the time you see this video, this option will probably have already expired. In fact, NVDA may even have announced earnings. So I'll be in a whole different position by then. But this gives you an idea of how I like to trade LEAPS call options and put them together with shorter term call options to form poor man's covered calls. So to recap, I like LEAPS options because it requires less capital up front, therefore I potentially have less capital at risk. I especially like to use LEAPS call options if it's a non-dividend paying stock. I can take that extra money, just be collecting interest on it or do something safe with it. But I also like that you can work a LEAPS call option by turning it into a poor man's covered call. You do that by selling a call option that has a nearer expiration than the call option that you bought. I also like that with LEAPS options, if you're buying them, the time decay or theta, it's a lot lower than a shorter expiration option. That gives you more time to win your trade. One thing I like to do with LEAPS options is to watch stocks that have had a big decline recently. Once I see that decline is probably coming to an end, I'll then look to buy a LEAPS call option or maybe even sell a LEAPS put option against that stock. And that's only for stocks I believe are undervalued and have experienced a volatility spike or a big decline recently. If it's a volatility spike, I like to sell a LEAPS put option. If it's a stock that I believe is leveling off and potentially going to go up in price, then I'll look to buy a LEAPS call option or do a poor man's cover call in it. If done properly, using LEAPS options can lead to explosive growth. But please make sure you completely understand all the risk you're taking before you place any trade, including a trade in a LEAPS call or put option. If you'd like to get an alert whenever I buy, stock, or sell options, check out the benefits of becoming a patron down at the link in the description below. If you'd like to see all the details and how you can use LEAPS options and poor man's cover calls to generate awesome cash flow and returns, check out the video series at the link above and the description below entitled Poor Man's Covered Calls and LEAPS Option Trading. Until next time, happy investing, and we'll see you again soon.